Guys, we're going to look at some stocks here that have had big drops in the last quarter. Let's check it out. First stock, HSY, which is Hershey. They make great candy. This is a moat business. People are going to be eating Hershey candy for a very, very long time. Market cap of $37 billion. High return on invested capital, 22%. That shows a moat. It shows they don't have to invest. They can get a really high return when they invest in the business. Mo, Hershey candies, like, what are you doing here, right? Yeah. Who's fighting Hershey? Fighting Hershey?
They control around 45% of the chocolate space in the United States.
If I gave you this market cap of $37 billion as a check and said, go compete with Hershey, how would you do?
It'd be very tough.
It'd be very difficult. Very difficult. Price to free cash flow, 23. PE of 20. Okay, let's look at the 8 pillars here. So guys, we love these 8 pillars. 2 X's, and they're on the valuation metrics of price to free cash flow and PE. Now, doesn't mean they're bad. It just means that could you pay a premium? Should you pay a premium for a high moat business? Absolutely. Also, you should pay a premium for a high return on invested capital business. The question is, if every investment's the present value of all future cash flow, what does that mean for Hershey? Yeah. Let's pull it up let's look at analyst estimates here. Mid to high single-digit EPS growth, according to analysts. Low single-digit revenue growth. Yep. Okay, makes sense.
Yep.
I'm going to go pull up our stock analyzer tool in the last time we did it. We did it December 4th. I did 2%, 4%, and 6% revenue growth, mostly because of inflation, Mo.
Okay.
13.5%, 15%, and 16.5% on the profit margin. Same with free cash flow. 17%, 20%, and 23% on PE and price of free cash flow. Okay. And I'm going to do 9%, 10.5%, and 12% desired annual return.
All right.
The stock's currently 182.
What do you got?
I got a low price of 112, a high price of 180, and a middle price of 143. And I have it on my watch list at 140. I'm actually going to change that to 150 now, so I can start selling puts on it when it hits 150 at lower prices.
All righty.
Mo, NIO is the next company.
Oh, boy.
Why you say, oh, boy?
EVs,
it's up a lot today.
EVs are back.
It's up a lot today because I believe somebody in Saudi Arabia is investing $2.2 billion in a NIO. Is
Nice.
that the news on it?
All-time high, $67.
On January 11, 2021, the low, just back in June, it's $7. It's now at $8.41.
Just looking at these key metrics, I see a lot of negatives.
Guys, they did $7.6 billion in revenue. The typical car company has a price to sales ratio between 0.5 and 1. It's at 1.9. And look at their gross margin, Mo, 4.4%. Guys, not going to lie to you, I am not touching this thing. I'm not touching this at all. I'm just going to move on to our next company, also a car company.
Okay.
Lucid. Wow. And just to go back on NIO, guys, when companies are still in this negative profit, negative free cash, I just look at it going, I don't want to understand that business. I have no desire to. I'm not here to try to get a home run on an idea that was losing money and hits it huge. I'm out. Lucid. First off, love Lucid cars.
All-time high, $65.
Absolutely gorgeous car.
$4.74.
$4.74. Guys, it is down year-to-date 23%, 5 years 52%, 1 year 34%.
And again, just a lot of negatives I'm seeing here.
Look at this price to sales ratio in a car company.
Oh my God.
Gross margin, negative 200%.
This is a tough investment. I mean, this is not an investment. This is pure speculation.
Pure speculation.
You're going to think that they're going to be one of the key players in the future, and maybe that works.
And by the way, I love that car. I think the Lucid car is absolutely beautiful. When I see it on the road, I go, damn, that's a good looking car. But again, it's still a car business. It's still in the car business. Mm-hmm. It's still a tough go of it.
Yep.
And these numbers are not investable numbers for me. But if you want to speculate, go for it. If you want to put a few shares in this thing, have a good time. Look at the market cap, $10.8 billion. Look at the enterprise value. They have plenty of cash on hand, but they're also burning through cash. They burned through $3.6 billion the last year. That's tough. Okay, next company, BTI, a company that actually generates cash, but people hate it because it's in the tobacco business. British Tobacco. Guys, these guys have Dunhill, Kent, Lucky Strike, tons of the smoking business. They generated $15 billion in free cash flow last year. Market cap of 66. That's a price to free cash flow of 4.5. And their free cash flow is higher than their net income by a lot. 15 billion versus 10, and 5 years of 15 billion again versus 9 over the last 5 years in income. They pay an 11% dividend yield that eats up about half of their free cash flow. Guys, go ahead, Mo.
Look at their profit margin and their 5-year. They are right on top of each other. That's very consistent profit margins.
Remember, would you agree that the smoking business is a declining business?
Yeah, I guess.
But if I offered you this entire company for $1, would you buy it?
Absolutely.
Why? Because you're gonna get 15 billion in the first year. Mm-hmm. Obviously, $1 is ridiculous. Obviously, $1 trillion is ridiculous.
Probably.
But at some point in the middle, it makes a lot of sense, right?
Yeah.
Is that today? Well, if you think the company's going to be around for, even if they're going from, even if they're losing $1 billion, their free cash flow is declining by $1 billion a year until they went to zero. Are you willing to pay $66 billion? Probably, because guess what happens? In 5 years, you get all your money back.
Yeah.
That's the key here. You got to sit there and say, what is going on here with this company? It is a declining business. Don't get me wrong. But the world's still expanding, and in emerging economies, people tend to smoke. And we haven't even touched Africa yet in terms of emerging economies. Yeah. So there's still a lot of potential, I think, for the business. Not necessarily in terms of growth. What do the analysts say about this?
That's a good question. Let's see.
Increase in earnings per share.
Okay.
And overall increase in revenue.
Yeah. Nothing crazy, but an increase.
Interesting.
So it's not technically dying yet, according to them.
I'm not even going to put it in stock analyzer tool. You know what it's going to say to me? Buy this thing. It. So guys, really quick, before we go to the next stock, if you like our tools here, you haven't even seen all the tools. We have a whole category of tools here. We have a whole community of thousands of investors talking every day. We have a free 7-day full access trial. Go to everythingmoney.com, try it out. Free 7-day full access trial. Baba, our next stock. Company I own. Remember, don't buy it just because I or anybody else on the internet has it. We're here to teach a process. But Alibaba has a lot of fear around it because it's in China. It had an all-time high of $320 a share back in October of 2020, and now it's at $74 per share. Now let's do some comparisons here. Back in September of 2020, they did $82 billion in revenue. Now they're doing $128. Okay. Actually, let me go to annual here. Let's just go to annual.
They have to be losing a lot of money, right?
$71.5 billion to 122. Profit is down in half from 21 to 10, but I think there were some one-time charges in there. Mm-hmm. The bottom line is, how do you feel about the business? The fear is China. Absolutely. And for a while there, the fear was ADRs, which is American deposit, with stocks, you don't actually own the company, you own access to the cash flow. And people say, that's terrible. I'm like, well, that's pretty much every company out there, especially China. So then that's already subsided. So this is a fear, of course. But let's go to the stock analyzer tool and see how it looks. The last time we did BABA was December 6th, just 12 days ago. I made very reasonable assumptions, 5, 8, 12% revenue growth, profit margin of 15, 19, 23. Free cash flow is higher. I did a PE of 16, 18, and 20. Mo, look at these numbers. Look at all this green. Look at all this green. Now, guys, don't buy it just because this is green. Understand the business and make sure you can deal with that. Mo, go ahead.
So I put in the same numbers as you, but I put a desired annual return of 20%, and these are still the numbers I'm getting.
I know. Guys, it will be a roller coaster ride for a while, right?
Yep.
Thank you very much for your time.